Now, ladies and gentlemen, please allow me to introduce our keynote speaker, the Professor Maurice Obstfeld from University of California, Berkeley, will present his presentation. Ladies and gentlemen, please welcome him with a big round of applause to the stage.
Well, thank you very much. It's a great pleasure to be here. I want to thank the KDI and the Ministry of Finance for honoring me with this invitation. And it's certainly an auspicious time to be talking about the role of the G20 in dealing with the global problems that pretty much all countries are now facing. I want to focus on the issue of monetary policy coordination. It's a very old topic, but I think it's one that has become relevant again, and that is clearly within the remit of the Group of 20. And so it's providential that I get to talk about it in front of this audience. Many are raising the specter of the early 80s disinflation again. We're now 40 years from 1982, which was a critical year in that process. And so it gives us a good vantage point to try to reassess where we are now and to put that in the perspective of our past experiences with monetary policy and international coordination. Just a roadmap of what I want to cover in my half hour. I want to document the central bank tightening trend, talk about the inflation problem that most countries are facing, focus quite a bit on the US, because the US is pivotal not only in, I believe, driving current macro developments, but in terms of the role of the dollar in the global economy. And I'll talk about the effects of the strong dollar that all countries are facing. I'll return to the global disinflation of the 1980s and how that built a case for policy coordination, and then talk about why it is likely even more important in today's world in which globalization has proceeded far beyond what it was back in 1982. Well, monetary tightening around the world. This chart illustrates what has been happening. The data are accurate up through September 9th. And in fact, this is such a rapidly evolving situation that the data are already out of date. This week alone, we will have or have had decisions by the Swedish Central Bank, which raised rates by a full 100 basis points, the Bank of Norway, the Philippines, the Swiss National Bank, and perhaps most prominently and importantly by the Fed, which will come very, very soon. But the basic message of this chart is that in 2022, interest rates have been rising sharply around the world. That is the red bars. They began rising in emerging and developing economies, and in Korea in particular last year already, starting in the summer. There was very little action in advanced economy central banks following the sharp cuts, and those are in green, in the critical COVID year 2020. But now central banks everywhere are raising, and in particular, the advanced economy central banks, one could argue, have been a bit behind the curve on addressing the inflation problem, which has proven to be more entrenched and less transitory than the optimists were predicting early in 2022, late in 2021. The global inflation problem is indeed dramatic. You can see in this chart the progress of inflation falling in emerging and advanced economies alike during the pandemic, then rising in the face of recovery as in many countries growing demand, pent-up demand, hit serious supply constraints and serious reallocation constraints. The pressures are somewhat more muted in Asia. That's something we can certainly discuss in the conference. related in part to the relative success of many countries in Asia in containing the pandemic itself. We're all familiar with the drivers, the stresses due to reopening. In some countries, reductions in labor supply, shipping bottlenecks, and higher transport costs, energy and food prices, very crucially, all exacerbated by the Ukraine war. And the silver lining may be that since the outbreak of the war, food prices measured by a general FAO index, as you can see on the right, have come down to the February 2022 levels. Energy prices have fallen. Part of that driven by fears of oncoming recession. Expectations are critical in driving inflation. There's evidence that indeed inflation expectations have picked up around the world. And a key question going forward is how persistent will these expectations be in the face of the actions that central banks are now beginning to take? I would argue that compared to 1982, when disinflation occurred in a context where inflation had been rising and becoming ingrained in people's psychologies for more than a decade, we may have been in a much worse situation than we're in today, where a spurt of inflation following reopening has followed more than a generation of price stability in most countries, and great advances in our knowledge about central banks' abilities to target inflation. I mentioned the centrality of the US, and indeed it is dominating the tightening cycle for advanced economies, also for emerging economies. The US recovered most rapidly from lockdowns. If you look at pre-COVID growth trend lines, the US made it back to the trend line first, even though labor market participation fell. And that was driven in part by a massive transfer of purchasing power to households and local governments. In the US, the jobs market is overheated, record levels of vacancies to unemployment, in other words, a very elevated beverage curve. Consumption remains healthy, and high yield spreads, indicators of financial stress, have not really, for the most part, jumped up yet. In some recent work done at Brookings with a co-author, Haonan Zhou, we show the important role in predicting the dollar of the excess bond premium measure of high yield spreads developed by Gilchrist and Zakrajek. That is not really elevated yet. It's been a very powerful predictor of US recessions. But another powerful indicator of US recessions, the Senior Loan Officer Opinion Survey of the Fed, has spiked up. And so it's not really clear that what the Fed has done is palpably slowing down the US economy outside of some sectors such as housing, which are very important sectors but are not the whole story. In my view, the Fed is not yet at neutral. It won't be there even if it hikes by 75 or 100 basis points later this week. But it's made decisive moves to get there and to communicate its resolve to markets. But the US real rate, to get some idea, the real rate of interest is likely still in negative territory, and it's got to become positive to solve the problem. This picture just shows where high yield spreads are. They've come up some in the last couple of quarters, but they're not at historically the levels that would be associated with oncoming recessions. US inflation, being very central to the system, has not really turned the corner yet. This chart shows the headline CPI. but also core inflation for the US and the Cleveland Fed's measure of median inflation, which many researchers have found to be a better indicator of future CPI inflation for the US than is core inflation. Median inflation, core inflation rose on a year-on-year basis in the most recent data for last month. They rose even more sharply looking at them on a month-on-month basis, and this is part of what has alarmed the Fed and alarmed the markets and led to talks of a possible 100 basis point increase this week. Not the market consensus by any means, but something that was not really even thought to be in the cards before that inflation report. Against this background, the dollar has strengthened broadly since the middle of 2021. Now, this process started even while the Fed was arguing that inflation pressures would be transitory, and even before inflation pressures had not risen to the levels we see today. But it has been a more or less relentless process of appreciation of the dollar, and each bit of negative inflation news for the US strengthens the conviction that the Fed will raise more sharply, which drives the dollar up further. This development has critical global consequences because historically dollar appreciation is associated with negative global growth, and even more strongly with negative growth in emerging and developing economies. In these two charts for advanced economies on the left and emerging economies on the right, the dollar exchange rates change is shown in green, whereas the percent of economic growth, of GDP growth, is shown in blue or yellow, and the negative correlation is very clear. Let me dig down a little bit more into this set of data, and here I'm going to draw on some data from the paper that Hao-Nan Zhou and I did for Brookings earlier this month. Dollar appreciation is, as I said, negatively associated with global growth, and it has become generally more negatively associated over time as the pace of globalization, trade globalization, and financial globalization have proceeded. It is negatively associated with world trade volume growth, and if you look at the data, here I show in the three columns, first, the overall correlation for the past roughly 40 years, the correlation in the first 2 decades of that period, 1980 to 2000, and then the correlation in the new millennium, the sort of heyday of globalization. And you can see that this correlation drops from, or rather rises from minus 0.39 in the last 2 decades of the 20th century to minus 0.61 in the first 2 decades of this century. Dollar appreciation is negatively correlated with the growth in the world investment to GDP ratio, rising from minus 0.32 at the end of the last century to minus 0.58 in the first 2 decades of this century. The correlation with advanced economy output growth rises as well. It rises marginally for emerging markets, which have always been vulnerable to the dollar, as I will come back to. The strong dollar of the early 1980s coincided with the massive debt crisis and a decade of lost growth in many developing economies. As I said, the growth in world capital markets, the greater integration of economies, the greater scale of international asset trade has helped drive these developments. The proliferation of global value chains has also been important. And also, the increasingly global nature of inflation has been important, as have been the influence of import prices, I believe, in estimates of Phillips curves. So in general, we're in a world where the dollar is very important. It's become more important, where there's been extensive globalization over the decades since 1982, and where probably the spillovers from US monetary policy and from the monetary policies indeed of all advanced economy central banks are probably much greater than they were in the past. In the early 1980s, synchronized global disinflation caused a deep recession in 1982 and crises across emerging and developing economies. The left-hand side chart shows measures of real interest rates in the US and globally, and the global nominal interest rate as constructed by one of our speakers today, Ayhan Koza, and his team. And you'll note the very sharp increase in the global and US real interest rates from the late 70s, when Paul Volcker is appointed at the Fed, to the early 1980s. This is to some degree a US phenomenon, but as you can see, it's also a worldwide phenomenon, as numerous central banks across the world struggled with the surge of inflation that had built up over the entire decade of the 1970s. Tellingly, real interest rates had been negative globally in the middle to late 1970s. This was a period of extreme monetary ease, which helped indeed to fuel the inflation that Volcker and other central bankers tamed in the early 1980s. If you look at the right-hand chart, you can see the path of global growth, whether measured at purchasing power parity, which is the IMF's favorite measure, or at market exchange rates, as the World Bank likes to do. And obviously, the global financial crisis and the emergence of COVID stand out for the very sharp negative global growth. But if you had looked at this chart before the global financial crisis, you would have probably been most impressed by 1982, when global growth fell to under 0.5% of GDP. So we should not discount the possibility that in this environment of general tightening of monetary policy, very low global growth would result. Generally, a rate of global growth of 0.5% would be considered a global recession by most measures. Emerging markets, of course, fell into debt crises in the 1980s as interest rates rose. This was a world with largely floating rate sovereign debt. And here I've transposed the path of the dollar, which is measured on the left, against the frequency of central bank crises as measured by the Levin and Valencia data set. And what you can see is that there was a sharp appreciation of the dollar starting in the late 1970s. It is on the order of more than 40%. So to put that into context, what we're looking at now compared to mid-2021 is more on the order of 10 to 15%, somewhere in that range. So we're not yet where we were in 1982, but obviously the frequency of financial crises in low and middle-income countries, even in a couple of high-income countries, rises. And even after the dollar was brought down after the Plaza Accord of 1985, there is a tail of crises because of the damage done. I should mention, since this is a financial stability conference, looking back at history, that the debt crisis was a serious threat to the capital of money center banks in the US. And had the international community in cooperation with the Fed not succeeded in persuading banks to continue rolling over debts, a serious advanced economy financial crisis could have emerged then. And in my view, this is one of the near misses that we all, as a global community, should have taken more seriously, and there were others prior to the great financial crisis of 2008. It was not an unmixed blessing that we escaped those earlier crises, because we also escaped having to learn their lessons. So where are we now, and is there a potential for other policy mistakes? One of the themes of 1982 was that, and this was expressed in a great academic interest in policy coordination at the time. There were a number of papers, including a very famous Brookings paper by Gilles Ludiz and Jeff Sachs in 1984. They made the argument that there can be a beggar-thy-neighbor effect of disinflation. When countries tighten and appreciate their currencies, if their exports are denominated in their own currencies, that can raise inflationary pressures in trade partners. And in an environment where everybody is disinflating, this is a beggar-thy-neighbor effect. Because when I tighten to appreciate my currency and disinflate, I make it harder for my trade partners to disinflate. They import some inflation. And so we can get prisoner's dilemma situations. I have a very simple example at the end of these slides, which I won't go through here, but you're welcome to look at, showing how a prisoner's dilemma can occur. And at some level, this is the obverse of the argument we heard many times prior to COVID, during the decade of recovery from the great financial crisis, that when the world is in a liquidity trap and a country depreciates its currency so that it can improve its current account surplus, that's beggar thy neighbor, because it pushes the rest of the world deeper into their liquidity traps. So that's beggar thy neighbor in a generalized deflationary environment. There's also the risk of beggar thy neighbor in a generalized inflationary environment. Now, I don't want to be misinterpreted here. I think it is too soon to pivot on tightening, and I'll come back to that. But we should be aware going forward that this is a risk. The other risk, more controversially, arises from the idea that in a globalized environment, each country's Phillips curve depends not only on domestic slack, but on foreign slack. Some policymakers draw the conclusion that if that's the case, then in order to influence one's domestic slack, one needs a particularly strong tightening response, because there are all these global slack variables that the home central bank can't affect. I think that's a bit myopic. And so I think it's important for central banks, in addition to thinking about the beggar thy neighbor issue, to also think about their joint interdependence in terms of global slack. If you really think that other countries' slack is affecting your inflation rate, then look around the world, because everybody is tightening. And so this is something that I think is important for conversation in fora like the G20, where the joint policy responses of the international community can be assessed. But the global slack issue doesn't raise a problem of beggar thy neighbor policies which can lead to suboptimal Nash equilibria. It is really just a forecast error risk, yet it's a potentially very important forecast error risk. The final point I'd like to make on this is that with more globalized markets, the risks of coordination failures, the risks of forecast errors from not correctly assessing what other countries' policies impacts will be for their own economies are greater than they were even 4 decades ago. So let me end by talking about the case for coordination. I know that in a G20 forum, when I talk about the need for cooperation, I'm preaching to the choir. So and if you want to break out in song at the end of this, that'll be fine. But you know, we have to recognize that every country, every member of the G20 will have different needs to reduce inflation going forward. Broadly speaking, I think countries will need to reach at least levels of neutral real interest rates to bring inflation down. But I worry when countries talk about moving much beyond to send a message to markets. I worry about the idea that you know, until we actually see inflation on target, we should, we meaning the central banking community, should not relent. And I think that may be overdoing it. I think the international coordination issues are important. The possibility of a global slump, which would be deflationary, in part through the effect on energy and commodity prices, is important. And we need to take these things really, really seriously. And you know, it may be that inflation expectations are not nearly as entrenched as in the 1980s, and that they come down more quickly than we actually expect, just as they went up more quickly than central banks expected. We can't rely on that, of course, but I think at a certain point, central banks will have to become more cautious than they have been as they have scrambled to make up for their tardiness in the recent months. Of course, each central bank could try to forecast what other central banks are doing and try to take that into account. That involves guesswork, and I think it's probably the case that countries are much better at evaluating their domestic economies than our foreign central banks, and this makes the case for international cooperation, not only through the G20 process, but through the surveillance of the IMF and other international organizations. It also, I think, provides an opportunity because central bankers cooperating to solve a common global problem, which is inflation, would be in a position to communicate to markets their resolve to quell inflation. And that could be powerful, just as in deflationary financial crisis, central bankers have coordinated on expansionary actions, and that has had a favorable impact on markets. Coordination now and skillful communication now, I think, could be an advantage of cooperation. And this might decrease sacrifice ratios. Those look likely, or at least possible, to be big. And in his presentation later, Ayhan Koz will talk about the just released World Bank paper he wrote with co-authors, which sketches out some very, very gloomy scenarios for global growth. So, you know, what is the basic message? We're in a situation with some similarities to the 1980s, when we also saw a role for energy and commodity price shocks and driving inflation. But we shouldn't be prisoners of the past. It's true that central banks have gotten behind the curve, they have ground to make up, but at a certain point they need to take into account what each other are doing and avoid jointly going too far. Listening to the current speeches of central bankers, the way they justify their actions, it's not obvious to me that they're paying enough attention to the global context. And discussions in the G20 would be an ideal way to try to ameliorate that gap in the international policy architecture.
Thank you very much, Professor Maurice Obstfeld. What an insightful lecture that helped us to look over the international financial market, including U.S. situation, and devise future policies. Thank you very much once again for coming all the way here. Thank you.